Hey everyone, and thanks for jumping back into the cryptoverse. This is DCA Live. We are here today live with Rob from Digital Asset News in the upper left. And then in the bottom over there is James from Invest Answers. And I just want to remind you guys that we rotate where we do this stream every Friday. So make sure you go ahead and subscribe to the other two channels. You can find a link to that in the description below. We have quite a lot to talk about today, is probably an understatement.
Yeah.
We're going to talk about, we're first going to start with Bitcoin. We're then going to sort of segue into some various macro things. Just to give you a brief overview, we want to talk about where major stock indices are, what that means for crypto. Then we're going to talk about everything going on with the Bank of England and kind of what's going on over there. They're at least temporary pivot to some form of QE while they're also raising interest rates. So, sort of policies that are sort of combating each other. Then we're going to go talk about core inflation and what are your thoughts about inflation going into the year? I mean, obviously there are certain things that have come back down a decent amount over the last several months, but some things like real estate remain somewhat sticky. And then we're going to talk about the S&P 500 and theoretical recession and what that would mean, and then general outlook for Q4. But thank you guys for coming. Pleasure to have you here.
Thank you.
Pleasure to be here.
All right, so pretty heavy questions today. We'll go through them as methodically as we can. So the first question I have for you guys involves the fact that major indices such as the Dow Jones, the S&P. We also know that the Nasdaq, I don't believe, has put in a new low beyond June, although it is close to testing it right now. Actually, as I speak, I think QQQ went down and put in a new low. But the interesting thing is that, as we know, right, a lot of cryptocurrencies have not. Bitcoin has not put in a new low. Ethereum has not put in a new low. Bitcoin still remains a few percentage points off its low. I think Ethereum is like 30% or something off of its June low. And even a lot of altcoins are well off of their June lows. One way that I was sort of thinking about it is that, we saw the Dow put in a low first, then the S&P, and we know tech stocks are kind of riskier, like the Nasdaq. Could that be next in line? And if the Nasdaq is next in line, what does that mean for crypto? Really the main question I want to get to is can crypto survive at the current prices, even if major stock indices get another leg down, or do you think that will pull crypto down with it? Because over the last few weeks, crypto has been holding up relatively strong compared to stocks, although we also know that crypto dropped a lot more earlier this year than the stock market. So we always have to keep that in mind. Rob, I'll start with you on this one. What are your thoughts? Do you think crypto can hold even if the stock market goes down, or do you think if one goes, the other goes with it?
I gotta be honest with you. I've been surprised. I've always been talking about the correlation between traditional stocks and crypto. But if we just take a look at, it's all about time horizons, right? So today we're down S&P, today we're down Nasdaq. But if we take a look at our market, we're up a little bit. But if you take that over like a month period, for the S&P 500, it's 9%. For the Nasdaq over 30 days, almost 10%. And if you take a look at Bitcoin for 30 days, 0.2, 0.3%. So, to me, it's remarkable that it's been this resilient because it really is a risk on asset, but it's holding its own. So I'm pleasantly surprised, and we'll see how it goes. I just don't think that if we see another major drop with the stock market, if crypto can just maintain flat or even go in the opposite direction. I don't think we're there at that point. I'm just actually a little flabbergasted that it's holding off so well.
Yeah, interesting take. James, I want to go to you on the same question and also maybe add in something else that I just remembered. And that is, stocks are also at their June lows, right, or slightly below. Is that a reasonable spot to potentially see a bounce? I think the Nasdaq is actually right around its 200-week. What do you think about these major stock indices putting in new lows and crypto not doing so just yet?
First of all, I think we need to step back and understand what's going on in the world. And currencies around the world, with the exception of the dollar, have been smashed like I have never seen in my life. Now I've been looking at currencies for 32 years. So that is like the pace of change has been astounding. So when you look at Bitcoin, some people still perceive Bitcoin as a currency. People are looking who hold currencies, and trust me, there's something like 40 trillion held in currencies. People are looking to park it somewhere. And that was very clearly represented on Monday of this week. The British pound Bitcoin pair traded $1 billion worth in a day. That has never happened in history. So all our friends in the United Kingdom were trashing their sterling and moving to a safe haven. This was something that we've been calling for. It's going to happen over the next 1 to 5 years. We don't know where, but to see a currency like that collapse so far, so fast, and then the gilt spike and everything else happen, we'll talk more about that afterwards too, was kind of astounding. So the other big thing is, the other angle is decoupling from traditional markets, risk on markets. First of all, NASDAQ is disruption, it's technology, which will always grow faster, but it's down. It also falls faster. It was down 11% in September. Now it's probably like 12%. And because those numbers I think are from yesterday, S&P is down 9.5%, adding the 0.5% today. It's down 10% for the month of September. And Bitcoin is, guess what? It's flat. And we were here 4 weeks ago exactly, and we were saying those famous words, this time is different. We said specifically that because the summer was so bad, September probably won't be a disaster at all, as is normally the worst month for Bitcoin. So putting all that together, I think I mentioned jumping out of a basement window. The bottom for the S&P 500 I see, worst case, is 3,500, so we're about 100 points away from that, which is nothing. At the 3,500 level, there's going to be about $800 billion going to flow into the market. There's $3 trillion on the sidelines, ready to be deployed. And now things are looking very juicy, very attractive. So I think it's only a matter of time before that, the closer we get, if we dip under 3,600, that'll trigger buyers. At 3,500, that'll trigger a lot of buyers, especially for NASDAQ stocks that are just beaten to hell. Some of them are at 15-year lows in a value perspective. So that's my take.
Okay. Yeah, I think you're a little bit more optimistic than me on the stocks. But, I mean, at 3,500, so that's not that much further down. You think there could be a pretty sizable bounce at that level?
Yes, exactly. And also, remember, when we look at indices, it's very important. It's like we always say 98 to 99% of crypto is ghost chains, BS type stuff. Well, the stock market, about 40 to 60% of, say, the S&P 500, will die or shrink over the next decade. So it's all about choosing the winners within the index. Use the index as a broad direction for where things are going. But remember, even if the index goes down, it doesn't mean your select name may go down. It may go counter to the current.
Right.
And that's important as investors to look for that.
We always have the idiosyncratic risk of every individual investment, which is why oftentimes just buying the market as a whole works out pretty well. The next question I want to talk about, and we probably won't spend too much time on this one, but the bank, and maybe we'll relate it to the Fed or something, but we know that the Bank of England recently decided to have some form of a pivot where they have started recently buying government debt. And I mean, it appears that they were more so compelled to do this to prevent the meltdown in the pensions, in the UK pensions. However, this is also sort of counter to to them raising interest rates. So we have on one side where they're raising interest rates because inflation is continuing to go up, and we're now even getting reports of inflation continuing to go up in various European countries, while at the same time we have some QE again. What do you make of this? How do investors respond to something like that? I mean, the first thing I think of is well, I mean, hopefully this isn't look, there's a lot of things that are different in terms of what exactly was happening in the 70s and what is happening today. But in terms of high inflation, right, that's the same. Do you think that, like, I'll leave it open-ended. Like, how do you think investors should interpret such a move? Do you think it will lead to very choppy markets for for years and years and years, or do you think that investors are just going to gloss it over in the not so distant future? And then the follow-up question to that is, how could something like this be, say, like a precursor to something that the Fed might do potentially next year or something? What do you think? And James, I'll start with you on this one.
Well, first of all, I think it's been such an interesting case study, because I would say if we go beyond a certain rate, it'll push us into financial Armageddon. I did not expect the financial Armageddon to hit so fast and the craziness to happen at this stage of the game. Now, what did happen, obviously, the bond markets are becoming unhinged. The new government within the UK are doing some things that are absolutely crazy. They're cutting taxes. They are funding people's electric bills to the tune of £100 billion in energy supplements or whatever. And they're jacking rates to fight inflation that they can't control anyway, because it's driven by extraneous circumstances. So the speculators are having a field day, pouncing on stuff. We also discovered something funny, which takes me back to the global financial crisis in 2008, 2009. And that was this concept of the LDI, the liability-driven investing, tying in pension funds. The pension funds are so illiquid and so desperate to make money, they're borrowing on margin to fill up their shortfalls. And as, of course, interest rates spiked, bonds tanked, margin calls come in, and there was no choice. And apparently BlackRock is one of those big margin callers too, because they manage a lot of the pension schemes in the United Kingdom too. So the whole thing is a recipe for disaster. I think, I think the good thing about it is the Fed sees what's going on, and the Fed has a very close eye on credit markets. And now we've got this whole pension wrinkle. The US is in a similar situation with a lot of unfunded pensions out there. So I think it's good for the markets, but it happened a little bit sooner and faster than expected. But they always say risk happens fast. Markets move faster now than ever before. So back to your question for investors, I think with this, the central banks now understand the danger of very rapid jacking of rates has on all sorts of markets, including exotic instruments like LDIs. And I guarantee you, there's more shoes to drop. There's other LDI type exotic products out there that are at breaking point as we speak.
Okay, fair enough. And do you think, would you say it's a precursor to something that the Fed might have to do?
Not yet, but I know the Fed is looking at credit markets, and credit is drying up. Liquidity is drying up. That's impacting businesses. And, again, I think they're keeping a close eye on it. They are in communication. I know that Jerome Powell is very close with Christine Lagarde, the ECB, and Christine Lagarde is in daily communication with the Bank of England. So they're all kind of moving the chess pieces around on the board, figuring out what to do. And the strong dollar doesn't also help the US in the long run either. And that's been a big problem. But it's good to see that come off the highs lately too. Sure. So we'll see where all this goes, but all of this will happen very fast if something does break.
All right, Rob, same question to you. What are your thoughts on what's going on with the Bank of England here?
Yeah, this goes back to the first thing we were talking about as far as time horizons. So you said the question was, well, how the market's going to react and should the investors take a sigh of relief? I think they did in the very beginning, because they looked at that and they go, oh, the central bank is pivoting. This is good. That means that if they pivot, then maybe the US will pivot and go down that route. So yesterday we had a nice little rally, did we not? Take a look at the different stocks, looking pretty good. But then today, I think people figured out and they said, wait, we can't keep doing that and raising rates and going there. And I think these are the things that really start to concern me as in the total macro, as far as the global economy. If you have an issue with pensions over here and you have to raise rates, then you have this illiquidity or insolvency for other pensions. And again, if we think of pensions, the way you just said, Ben, about, and you have to get more money into it, it almost sounds, I'm not going to say it's what it is, but like a Ponzi type of, we need more money to come in to figure out this other thing with the other part. I find it very dangerous. I just don't see how they can continue to ease, to start money printing and then raise the rates and go from there. Because even the inflation rate for the UK, I'm looking at true inflation right now, it's almost 16%. And it's been going up since December of last year. So I think this could be like James was talking about, a little bit of a recipe for disaster.
Interesting. The one thing that we've watched in markets the entire year is inflation, it's been the story of the entire year. CME Group continues to sort of have, we can see the probabilities for 50 basis point rate hikes, 75 basis point rate hikes, but ultimately the decisions there are going to be heavily influenced by where inflation comes in. And I think we have a new CPI report coming out October 13th, I believe. So in just under 2 weeks or so. And I know on the sort of the website that I use to track it, they're forecasting headline CPI to stay at 8.3%. Not that their prior forecasts have actually hit, but I think they're forecasting it to be at 8.3, and then they're forecasting core to be at 6.4. Is there any reason to believe going into Q4, so like October, November, December, is there any strong reason to believe that inflation will come down in any meaningful way? Will it come down in a linear process, or is it going to be a lot stickier? Will it be, say, more stochastic, where it maybe comes down and then it just goes right back up for a while and remains somewhat sticky? Rob, what do you think? I mean, what are your expectations going into Q4 with regards to inflation?
With the aggressiveness that the Fed was going through with hiking the rates, I would have said, yeah, that makes a lot of sense. But we take a look at the PCE, and you just tweeted this out, a couple hours ago, where he said, yeah, we're at 4.9. The projection was 4.7. And I took a look at that on the Fed website, and here we are, 4.91 as opposed to 4.7 in July. And I took a look and I said, well, that's not too bad, because in February we were at 5.4. But then I remembered, I'm like, but there has been so many aggressive rate hikes. Rate hikes that we didn't think were going to actually happen a year ago. And now here we are. I remember 75 basis points was laughable. And now here we are going, well, we're going to hit another 75 and maybe another 50. So if I can say that, if I had to gamble and bet, I would say that these rate hikes that we're doing, and again, this is stripping out energy and food costs, are still going to go up, even with the aggressiveness that the Fed is doing, as based on these numbers today.
Okay, James, what are your thoughts? Clearly markets are now thinking 50 to 75 basis points next month. Do you think CPI is going to surprise either direction in a couple of weeks, or what are your thoughts?
I think there's a couple of sticky elements. For example, the wage inflation, but I think that's being taken out by unemployment will increase shortly. People are now nervous about their jobs. The amount of hours worked is falling fast. But I don't know if we're talking about labor or unemployment markets later, but we'll chat more about that too. But the big component is housing. I think it makes up 42% of the CPI. That whole industry has just ground to a halt. It's like a bug going through the windscreen of a car, just smashed completely. Oil is tanking. It's under $80 last time I checked. Food is a bit sticky. The US has that a little bit more under control. So I do think we could get a little more of a faster decline in inflation. And hopefully the Fed will stick to their guns and say, we are data driven. I know we're looking in a rearview mirror going back 18 months or so, but hopefully they'll pick up on some of the new data that they see and make a decision around that.
Okay. Yeah. One thing we've talked a lot about are macro bottoms for the stock market, and sort of like figuring out a general timeline on that. Look, it's clear now the June low was not the low. I still sort of will navigate this with my bearish goggles on, because it's still hard to fight the macro environment. We can get counter trend rallies, of course. My question though is, if you look at like prior recessions, okay, and I was sort of like counting them all up from going all the way back to the 40s. If you look at prior recessions, we can see that the S&P 500 bottomed, somewhere maybe around halfway to 2/3 of the way through the recession, with the exception of the 2000 to 2002 bear market. You could argue that maybe we kept going down after the recession because of 9/11 or general fears related to that kind of stuff. But in general, the recession, like sort of that period where the recession is ultimately where the bottom has occurred for the S&P 500. And there's a lot of debate today as to whether we're in a recession or not. You could point to say 2 consecutive quarters of negative GDP as a reason that we are in one. You could look at, you know, the inversion of the 2-year and the 10-year as a reason why we're either in one or headed into one. But the counterpoints, like just from like say like an academic perspective, you could say, well, the counterpoints are that the 3-month is not inverted the 10-year. Normally, that's a great indicator of upcoming recession, and unemployment still remains extremely low. I think my question is there any reason to assume that the bottom is close to being in when normally it doesn't come until we're in a recession? And as according to, say, unemployment data, right, there is at least some evidence to suggest that we're not in one. I mean, of course, we all have our opinions on whether we're in one or not, but what are your thoughts with regards to that? I know it's a very complicated question, right? Like there's not like just an easy answer, but James, what do you think?
Well, you touched on a bunch of different stuff there. So let me tackle the last one first and try to remember what you said. So first of all, jobs. When you dig into the job data, it's extremely misleading. So the hours worked is falling down on average, I think is 4 or 5 hours a week per person, which is good. Second of all, the amount of full-time jobs is falling. The part-time jobs is rising. And if you work, say, 3 hours a week at the gym, that's considered a job once you hit payroll. And the president will say, look at that, great job. And somebody may earn $45 for the week. That's a job. But no, it's not really. The other big problem is now 5% of households in the US have 2 or more jobs. That 5% may not sound like a lot, but it is a lot. Back to some of the other kind of recession data, et cetera. I think the Chicago PMI data came out this morning. They expected 53. It came out at 45. Again, manufacturing in that Illinois area ground to a halt. It's back to May 2020 levels, which means we were just still emerging from C19 at that time. We're definitely 2 quarters into recession. It was, I think, minus 1.6 in Q1, minus 0.6 in Q2. They might cook the books. Typically, they come out with Q3 numbers, and there might be plus 0.1 or whatever, but then they ratchet it down to negative later just for looks. Retail has a huge inventory overhang. Copper demand is falling, which is another big macro indicator. So again, everything is definitely crashing down. But I think your question was how far into the recession before the bottom of the market. I think markets respond much faster. They move much faster. And I think that 3,500, 3,600 is very, very close to the bottom. So we're pretty much there. But everything is, the demand destruction is like I've never seen before. There's other things as well. The credit I mentioned at the beginning, if you look at credit default swap levels right now, they are at an alarming level all across the world, all at the same time. And I hope the Fed looks at this too. Credit's drying up, which means businesses are suffering. Refinancing costs are exploding. Anybody who had variable line of credit, now their fees are more than twice, which means they have to lay off people, cut businesses, maybe even go out of business. So things are definitely bad out there. But I think the bottom is very, very close too. And the question is, how long will this last? I do expect a bear market rally in Q4, but what that rally turns into is a function of how the Fed responds. If they move, if they pivot some way, or do a little bit of QE, or if there's some type of liquidity disaster like we just had in the UK, then of course the printers will start running again. And technically, the printers are still running because of the student loan forgiveness, the energy, clean energy IRA bill, and everything else. So that's not happening.
Fair enough. Thanks, sir. I feel like you actually tackled all the points. That's a good job.
Did I? I mean, I know must have missed one.
Rob, what do you think? I mean, I don't want to go through the whole question again, but what are your general thoughts about what I said earlier?
So I know, like that was pretty comprehensive, what James said. But just take all that, what James just said, as far as like the negative parts, and then take a look more at the actual macro events that are going on. Look, potential nuclear war in the Ukraine. We've also got Putin has said that he wants to do peace talks, and Zelensky just came back and said no to the peace talks, and also they want to fast track into the NATO membership. And then, I mean, you have just that part. And then, of course, there was the Nord Stream pipeline sabotage. So you're going to see a lot of negative effects as far as like electricity and the the rates of electricity going up for Europe Union, especially Germany. See, if you take all those things, and I know James says, well, the money printer is going to go back on, but how long can they keep that money printer back on before we start to see more inflation? I mean, sweet Jesus, we just had them raise those basis points up, and those numbers just came out today, and it still is going up. So I look at this and I go, I don't think that the bottom's in. I don't think it's that close. I think we're going to have a lot of more issues coming forward. And then if you take, there was this one thing that came up. It was the Buffett indicator. I don't know if you ever heard about this one.
I have.
Yeah, it takes the latest quarterly estimates for the GDP and takes that by the total market cap of the stocks. And right now, if we take a look at it, in November last year, it was at 200%. And then right now, we're at the same level we were before the crash of 2000, which was the dot-com bubble, which was around 148%. So if we think that the bottom's in, I don't know if the bottom's in, but if you take a look at those factors, I think we got a ways to drop.
Well, let's take a step back, because you did say something, Rob, and I don't want you to misquote me because the internet doesn't forget. But I didn't say they'll turn the money printers on, but something will cause them to change their course of direction. Okay,
to pivot,
slow down the rate of change of interest rates, or cut them back, or whatever else, or do what the UK did. Something is going to break very easily. But if you look at the simple math, there's a beautiful little ratio of, say, the stock market, the S&P 500. I'm going to try to pull it up here. If we go to, and I heard this from my former professor this morning, I thought it was brilliant, but I haven't actually tested it yet. If you go back to 18th of February 2020, right before C19 hit, stock market was, call it 3430. Okay, multiply 3430, multiply 1.4, which is the money printing, the increase of money supply since that time. Therefore, the fair value of the stock market should be about 4760 because of the debasement of the assets because of the money printing. So that doesn't mean the stock market is actually appreciating in any way. It's just inflating with the increase in money supply. So that's the other angle. And it's funny because when I calculate that 4760, I know Tom Lee from Fundstrat, his target is 4800 by the end of the year, which I don't know if he used the same calculus to get there, but I thought that was worth sharing too. So who knows? Again, right now, my point is, market is very undervalued. We're at 15-year lows for many assets, and we'll see. I think Q4 could be good.
Well, I mean, that actually leads us into the next question, because, I mean, look, from a macro perspective, there's plenty of reasons to be bearish. I mean, it's not like you have to look that far to at least see like certain things that are causing uncertainty, and obviously markets don't like uncertainty. So we could talk about the bearish scenario all day, but what's the sort of what are some, this is a two-part question as well. I'll try to keep this one shorter. What's your general outlook for Q4? So like for stocks and crypto, general outlook. But then like what could you see as some positive narratives forming around crypto over the say the next like 6 to 12 months? So regardless of what price does over the next few months, let's just pretend we're out in say mid to end of 2023. What are those narratives going to be that are going to send us back into a bull market? Okay, I mean, because there's also a difference between ending the bear market and then just going sideways for a while, because there's if history isn't any indication for Bitcoin, you do go sideways for quite a long period of time. You look at 2019, you look at 2015. These are years that came right after Bitcoin bear markets, and they were mostly sideways. I mean, there was volatility in 2019. There of course was, but we didn't end the year that much higher than where we started it. So what are your general thoughts on Q4 for both stocks and crypto? And then what are some positive narratives you could see forming to sort of send the next bull run going for crypto? Rob, I'll start with you.
Yeah. So like what I just talked about was pretty much the most bearish scenario that I could think of. But if we want to take a look at some positives, you have to understand that first week of November, Super Tuesday is coming up for midterms. And once those get out the way, usually in about 30 days or so, you start to see more of a rally with traditional markets. And then you see it even more so in 60 and 90 days. And there was a good graph that we talked about a couple of days ago, which just kind of shows that since 1962, the same type of thing. So there's that, you could have that. Also, if we get positive, I know people might be saying this, but it's the truth. if we get positive regulation come through, like the Lummis bill from Wyoming, Responsible Financial Innovation Act, if they can somehow get that through or make positive to that and actually get it, then that would be good because it could settle a lot of things with the CFTC and the SEC. It could get us regulations, tax treatments, stablecoin regulation, that type of thing. And I think if we understand the basis that institutions are leading this charge, that's what they want to see. So if we get something like that, and then we have these massive institutions going, okay, finally some clarity of what we can do and how we can protect ourselves. Now we go in. I think you get something like that, then I mean, you're off to the races. I don't see how that could fail.
Well, even with with a Ripple and the SEC, it seems like they're making a little bit of progress. These are all things that I think a lot of us just wish were behind us, you know, like we just kind of want all these things to be behind us. Like bring us the regulation, tell us what's what and who's who, and let us invest without having to worry about this stuff anymore. James, what do you think? I mean, I think you already said going into Q4, you think there's likely going to be a bear market rally, and then the sort of the extent of that or what that ultimately becomes, whether it's an actual macro bottom or not, will depend on what the Fed does. Could you elaborate and then talk about some potential narratives for the next bull market?
Well, one thing to mention, because you're talking about regulation moves at the speed of government, okay? Which I expect to laugh from Rob on that one.
It's
a long time coming. You know, they don't even know what they're talking about, and they're trying to write law around it. It's comical. So Q4, why I believe it could be strong. One, elections are coming. Hopefully the existing people in power will become lame ducks, because markets always perform better during lame duck sessions. And I'm reading different signals as to what's going to happen between the left and the right, et cetera. It's all a mess anyway. And I don't take any side. I'm right in the middle. I just want peace and prosperity for everybody. Second, inflation is falling. We don't know how fast, but we reckon with the demand destruction in place, it's pretty fast. And we'll get some good CPI prints over the next 2 or 3 months. Third, markets are definitely bottoming. 3,500 is basement floor, upside 4,800 within 6 to 12 months is my take. And there's tons of cash on the sidelines, 3 trillion waiting to be deployed. I think I mentioned at the beginning. The peace talks from Putin that just came out 2 hours ago. I actually missed that piece of news. I was looking at the markets. If the war stopped, that would be game on. Fourth, fifth point, I don't even know where I am now. In terms of the Fed, they talk a big game. They do a lot of jawboning, but do they have bite? And watching the credit markets roiling like we are seeing right now, after seeing the UK blink this week, after seeing Germany print, China saying very clearly they're going to dump the rest of their $1 trillion in treasuries as quickly as possible. That's going to put downward pressure on the Dixie, and hopefully help some of the other emerging market currencies. We are seeing contagion starting in Sri Lanka, or maybe it's already well into the fourth inning, I'm not sure. But the world is kind of a tinderbox. We did see those cracks emerge this week. And we'll see. I think the central banks now need to be very careful how they go forward. There are extraneous circumstances, like I think I mentioned before too, that they're not in their control. But they need to make sure they keep the trains on the tracks and not just blow up the whole world. And I do believe there's more shoes to drop. That could happen very quickly. There could be more pain, but again, the lid on our markets is firmly on. But just seeing, back to crypto, we expected a bloodbath in September. We didn't get that. Bitcoin is now up since the 1st of September, and that's a huge positive. And some alts are actually doing very well too, with the exception of Ethereum. So we know Q4 is good. We know October is often called Uptober and Moonvember, and all these different names are out there. I expect good things, especially now with people now seeing how their domestic currency is getting crushed. They're looking for a hedge. And it just takes a little bit, deploying 1 or 2% of money or assets has a huge impact on Bitcoin. So I see a good Q4 from here.
Fair enough. I want to make a couple comments about that, but before I do, if you guys have questions for us, go ahead and ask them in the chat. We'll try to go through those. Yeah, as far as September, I wouldn't say that a bloodbath was necessarily going to happen, but generally September isn't the best month for crypto. Bitcoin is only down about 1%. So far it's actually been a fairly good September. Ethereum is down 13%, so quite a bit more. And if you look at the total market cap, it's only down about 2 to 3%, so relatively tame. And I was actually looking at October for Bitcoin, and what I noticed is that it is typically green. So,
Yep.
but there's some exceptions. So the two last red Octobers were 2018 and 2014, right? I mean, and those were the last two bear markets. So yeah, I mean, we certainly could have a bear market rally in October. I think everyone should be prepared for that. But at the same time, we have to recognize that in bear markets, the general trend could, it might not always hold what's normal. Because I mean, like 2021, we had 40% in October. 2020, we had 28%. 2019, we had 10 or 11%. But in 2018, we went down 4%. So it's just something to keep in mind that it ultimately, I guess, depends on how long the bear market drags on, whether you think the bottom's in or not, or yeah, lots of that. But if you guys have any questions, let me know in the comments, and I'll try to get as many of those answered. So let's scroll up, see if I missed any. Well, some questions that are probably not worth asking.
As you're looking at that, just a quick question about what do you guys think about these 2-year treasury rates and the 10-year treasury rates? It seems like, I mean, I know that people will say, well, inflation is so high, but I mean, over the last 5 years, I think they're at their highest point, or even 10.
What's interesting is if you look at, I believe it's the 2-year treasury. This is like a weird statistic, right? But if you look at the 2-year treasury, wherever it peaks, you normally find a major bottom like exactly 2 years later. That doesn't mean you can't. That doesn't mean you can't have like an intermediate bull market in there somewhere, right? But if you go look at prior 2-year peaks on the 2-year treasury, and then fast forward 2 years after that, and you'll find a lot of major bottoms in the stock market.
I got to take a look at that. That's interesting. I just, when I look at these, I'm like, because we're always talking about, where to park their money. If I had a ton of money and I'm like, well, I got a bunch already, I could just put it into, these T-bills and not have to worry too much about it. I mean, granted, I know inflation, but I mean, what's the return going to be on the traditional markets moving forward if there is no bottom?
Yeah, and the difference, Ben, and it is different this time because I did hear your point. When we have this heavy level of inversion, because that's what I look at. I look at the 2-year minus the 10-year, and you compare that to the S&P 500. Normally, when that peaks, the stock market tanks. But this time, the stock market tanked before it peaked. That shows you how messed up the financial world is. Remember,
well, wouldn't the counter argument to that be that it hasn't peaked yet and the market could still tank?
You could argue that, but the problem is we're coming out of zero rate environment. That's never happened before. The money printing that has happened has never happened before. That's why I always say this time is different. It really, truly is.
Yeah,
there's no analog, is what I'm trying to say.
I think the main thing that keeps me cautious are just looking at prior bear markets, looking at like 2000, 2008, and other bear markets that they can last for more than 9-10 months, right? I mean, they can go on for well longer than that. So I'm just thinking if we're sort of in this game where the Fed's raising interest rates and they're going through QT, we still haven't seen unemployment start to go up. We also know that the stock market bottoms before unemployment peaks, but unemployment hasn't even started really going up yet. So that's kind of a lot of things that keep me relatively cautious, because I'm like, well, unemployment hasn't really, I guess the main counterpoint to my own argument could be that, well, if the Fed is able to engineer a soft landing, then maybe unemployment doesn't really have to go up as much as it might otherwise would. But I think those are the things that mainly keep me cautious.
And a couple of things regarding the unemployment numbers. Unemployment has gone up. You just don't see it. It's invisible because of the Great Resignation, because of C-19, because of people having multiple jobs, and because people having these little part-time jobs that are 2 to 4 hours a week. That gives you a very misleading indication. If you look at total payroll, it's a pittance compared to what it used to be. If you look at productivity, it is disastrous, which shows you people aren't working. That is the difference. So again, you're looking at these numbers from 30,000 feet. Yeah, they look good. But you dig into them, they're not good at all. And that's the big difference here.
Well, they look good for midterms. I'll tell you that. Because if you're gonna go into it and go, hey, we're doing the right thing. This is our establishment is doing fantastic. It's a good talking point, I must admit. And that's just how it goes.
What was the joke? The the act was signed, and 2 days later, Biden declares victory over inflation because there was 0% inflation. I mean,
you know, my point here is I fully understand the idea that a lot of the data is probably erroneous to some degree. I mean, I wish someone would ask Powell, hey, how can we have all these new jobs but productivity keeps going down? Like, what do you make of that? But the other thing I understand, like, unemployment is probably higher than where they say or where the data says it is. But I think that the counterpoint to that is that it doesn't really matter if that's the case, if the Fed is going to point to that data to continue raising rates and to continue on with QT. If they're going to use that data to say, look, we can keep doing this, it's still likely going to put downward pressure on markets, even if unemployment is higher. It just means they're going to make it worse and probably not engineer a soft landing. And if they don't engineer a soft landing, then, I mean, forget 3,500. We would go much lower than that. I mean, if we're in for a hard landing.
There's no soft landing.
So if you, I agree. Honestly, I feel like the idea that the likelihood of a soft landing is relatively low. But if you go back and look at, I don't know, the last like 10 recessions, I think you could argue that, or 10 of the last rate hiking cycles, I should say, maybe like 3 of them or so, the Fed was able to engineer a soft landing. I think the hard part with this time is that they're raising rates as the economy's slowing down already, and they don't have the luxury to stop because inflation is high. So that makes it really hard to engineer a soft landing.
Yeah. And then the big factor that people forget is the impact of these very aggressive, very fast rate hikes. You don't see the impact of them for 6 to 12 months. Right. The pain is yet to be felt. So even if they stop today, we'd still be feeling pain 6 months from now, plus. So the other angle.
Yeah, it's going to be painful for a while.
Let's get to some audience questions. Here's an interesting one. Will the equity market bottom before Bitcoin?
Bitcoin bottomed at 17.6 on June 14th. I think, correct me on that date. I think it was June 14th.
So you're saying that, so you think Bitcoin bottomed first, is what you're saying?
I think it did. I think when you look at markets, it's really fascinating. Over the last 2 years or so, Bitcoin is the early indicator of where the markets go. It's like the stock market follows Bitcoin. Maybe that's by virtue of the fact because it trades 24/7, or by the fact that the people that trade it are smarter than people that are trading the general equity markets. I don't know for a fact, but it is, and especially when I saw the decoupling over the last month of September between NASDAQ, S&P 500, and Bitcoin, that blew me away. That was quite impressive. So, Rob, you look like you're in disbelief.
Well, I don't think that the stocks and equities are following Bitcoin, but I could be wrong, because I mean, like, if we take a look at like the 1 year, you're down 16%. If you look at the NASDAQ for 1 year, you're down 26%. If you look at the 1 year for Bitcoin, you're at 52%. So it's a little different.
Well, there's also
faster.
There's also the point to be made too. I mean, I know James says he thinks the bottom's in for Bitcoin, but there could be a case where Bitcoin bottoms first before the stock market, but it just hasn't bottomed yet, right? Like, that also could be a scenario that exists.
And see, this is the thing that concerns me, because, like, I mean, they're both valid points. And I think people watching right now and going, well, it could bottom, or people think, yeah, it definitely did bottom at 17.6. But for me, I'm like, I just don't know which way it's going to go. So I still do a little, like I say, micro DCAing into it, because somebody's right, and I don't want to be on the sidelines. So I hedge my bet.
That's the name of the show, right? Like, DCA, we give our talking points and what we think, but it doesn't necessarily mean that, just because you might lean bearish or bullish doesn't mean you're not hedging for the other thing as well. Like, if you think the bottom is in, you still probably have some cash in case it's not. Or if you don't think the bottom is in, you probably still have some Bitcoin in case it's not too. So, I mean, I think it's probably smart to hedge either way. But I think the one thing that I constantly am looking at, again, I mentioned this earlier, is that the Dow was already put in a lower low. The S&P followed. The Dow, I believe, is already at its pre-pandemic high, I think. The S&P is not. The NASDAQ clearly is not. I'm just wondering if it's just one domino at a time, right? The Dow first, then the S&P, then the Nasdaq, then Bitcoin, then Ethereum, like, kind of just getting riskier and riskier as you go along the curve. That's why I'm concerned about Bit. But listen, even with that said, if Bitcoin pumps, for a while, let it pump. I mean, Q4, if you think back to last Q4, Bitcoin pumped almost like right when October started, actually. I think it started like right on October 1st. The dominance of Bitcoin just shot up for about a month while Bitcoin pumped. We'll see if that happens again. But
and again, using the Dow as kind of an indicator, I think is a mistake because it's full of zombie companies that are going to shrivel up and die.
Yeah.
And
well, I mean, the same thing could be said about crypto too.
Absolutely, yeah.
Well, that's all the 100 and belows, or 300 belows, we'll say.
But the Dow is very much lagging. Like, for example, I think it was Nike earnings. I think Nike is a Dow component. Their earnings came out today. They got smashed, and they're saying, God, we got to cut prices. We've got too much inventory. As I mentioned, the inventory overhang at the beginning, all the retailers are suffering from that. And they got the companies that sell poisons like McDonald's and Coca-Cola in there too. I don't know. I don't know.
Here's a good question. Kevin O'Leary has talked multiple times about the positive effects of government regulation on crypto. What is your take on that?
100%. Absolutely. If the crypto is deemed a safe space, the money that will come in will be ginormous. I mean, we're going to see things 3x in a very short window of time.
Yeah.
That's what's very positive about the CFTC and Bitcoin. Deeming that a commodity changes the game, but it's not in place yet.
Right.
Yeah.
Let me do some fast questions here because we're getting actually a lot. Here's another one. What if QE comes in the form of direct cash payments to lower class and interest rates remain around 4%? How will you navigate the market?
Well, it depends on how much they're actually going to be, printing out and giving away. Is it like a test case like they did in California and Denver, or is it going to be something like nationwide? And it depends on the actual amount that comes out. I think they would have to test that first, like they've already been doing, and then we kind of go from there. I don't think that's going to be a very long, drawn-out thing or a very massive thing.
Kevin says the riskier assets bottom first usually. That'd be an interesting study to go back and look at all the prior bottoms. Like in 2018, I know we saw the stock market sell off at the end of 2018 and we saw Bitcoin, but I'm not actually sure exactly which one bottomed first.
No, that is dead right. Risk happens fast. The riskier assets, the more volatile assets tank first. That's why we're seeing the Dow, which is full of laggards, beginning to tank later because, again, they're looking 3 months, 6 months behind.
Rather than leave this up in the air, I'm going to go look. So I believe he's right. So if you go back and look at the S&P in December, it looks like the S&P bottomed on like December 24th or 26th or something of 2018. I'm pretty sure Bitcoin bottomed before that. Like, I think didn't it? It's been a long time.
No, it did.
Yeah,
2018?
Bitcoin, 2018. Yeah, Bitcoin bottomed like December 15th. So it bottomed a couple weeks earlier. So yeah, I mean, it's a fair point. There could so James's point could be right that Bitcoin bottoms first. I mean, I know you think Bitcoin has already bottomed at 17.5, and you could be right. But even if Bitcoin hasn't bottomed, it still could bottom before the stock market does.
Well, let's clarify that too as well, because there's bottoms and there's bottoms. If something does happen, if somebody fires a nuclear warhead or there's a black swan event, everything comes down. The question is, which will come down faster or more? And that's the perspective. And crypto falls 4 times faster and more than other assets in general.
Yeah.
So keep that in perspective. Like if the S&P falls 10%, crypto could fall 40%.
When Bitcoin moves, it really moves quickly.
Exactly. That's why that's why I just do a little dollar cost averaging, because you never know. Because like James could be right, Ben could be right, but I think in 18 months, not going to make a difference. 1824, we'll hit our stride later.
All right, more questions. Someone says
Ben's loving questions today.
Yeah, well, I'm just trying to get so wouldn't it? Some questions aren't really exactly that coherent, so it's hard to even know what people are asking. Yeah, I mean, we're just talking about some prior events in crypto. Someone says predictions on the total market cap bottom. So, I mean, what do you think about that? Do you think the total market cap has bottomed for crypto, and if not, what would you say the bottom would be?
Well, what alarms me about the total market cap of crypto is you've got things like Doge in the top 10 That just shows you how absurd this market is and how absurd some retail investors are to be scammed like that. And there's many other names too. So again, like the Dow, like the S&P, you got to excise the winners out of the big bag. And that's what you need to focus on. But don't get too sucked up by large, CMC is 1 trillion or 3 trillion. It doesn't really matter. It's what the winners in the index do, is my take. What do you think, Rob?
Jeez, first of all, I just took a look at Dogecoin. The market cap was $8 billion on Dogecoin. What does Dogecoin do?
Yeah.
Well,
Jeez.
I think, weren't there some text messages leaked recently that Elon was trying to use it for like it would cost 0.1 Doge or something to tweet or something.
Yeah, that's true.
Dude, if that's all it takes, that's all it takes. But yeah, there's some solid, like Polkadot is below Doge. And look, if you own Dogecoin, I'm not saying it's that's wrong of you. I'm just saying, I'm asking the question, like, what is the real utility? What is going on behind the scenes? How much development is going on? It just boggles my mind. You got Avalanche and Uniswap, which people use every single day at a mass amount, is number 18. Jeez Louise, that's crazy.
I always have a trouble.
What it is.
I always have trouble buying Doge myself. Like, I don't own it, and I've never owned it. But who am I to laugh? Because the people who did own it, they saw some pretty incredible gains back in, more than once, actually. I mean, not even just in 2020 and 2021, but Doge did really well in the last bull market, too, at one point. Perhaps, I mean, just say, like, perhaps the fundamental aspect of it is that if you have billionaires promoting it, it can do well in a bull market, right?
That's marketing at its finest.
Because you also
right
had
there.
Mark Cuban. You also had Mark Cuban promoting it because it's like you could buy Mavericks merchandise with Doge, I believe. All right, let me see what some other questions are. We're gonna maybe do one more question, two at the tops, and then we're gonna let it go. Okay, here's another one. Why is gold doing so badly in a high inflation area? Maybe they mean environment, but why is gold doing so poorly? James, you want to take that?
Yeah, it's unlimited in supply and it's heavily manipulated. And who buys it anymore? Does anybody under 50 years of age or even under 60 buy gold anymore? No, they buy other assets. So I just don't think there is the same need for it. And I've been saying as well all year, gold today has the most perfect macroeconomic backdrop it'll ever have. War, high inflation, etc., and it's still going down. So once we go risk on again, gold could languish further. But yeah, I feel sorry for all the gold bugs out there, but it is a bizarre time.
I'm not as bearish. I mean, I used to be pretty bearish on gold, like especially for the last decade, but I've actually gotten a little bit more bullish on it recently. I don't have a ton of gold or anything, but I could see it. I could see a scenario where it does well, but I don't see that scenario happening as long as the dollar keeps climbing. If the dollar keeps climbing, I don't think gold's going anywhere.
Exactly. And technically, you could argue because the dollar is climbing, gold is actually going up in value. You just can't see it. Because a lot of people are buying gold with $7 dollars.
Look at gold's value against other fiat currencies, right? Maybe
it's
not
going up,
right?
Yeah, exactly. So it's all in perspective, but again, weird time.
All right, last question. I'll let both of you guys answer this one, and then we'll sign off. Do you think equities and crypto can perform well without Fed liquidity? So without QE, I guess, is what they're talking about. What do you guys think? Rob, do you think, let's say we get through the bear market, we get through our accumulation phase, we're at our next Bitcoin halving, and to be frank, my opinion is that the Bitcoin halving is a great narrative, and I'm sure it brings in people, and I'm sure it helps the price, but you also have to have access to liquidity and stuff. What do you think? Do you think crypto and stocks can do well without liquidity, or do you think they require that cheap liquidity from the Fed?
It just depends on where the funds are going. So like if we talk about gold's got a market cap of $12 trillion. And we have what? We're $960 billion. So if we take a look at that, the housing market, derivatives, just global wealth around the world, you're looking at almost $2 quadrillion. So why couldn't Bitcoin and the crypto market increase a little bit higher to 8 trillion, 10 trillion, 20 trillion as people figure it out? Now, as far as equities, I can see that flowing in from different parts, but It just depends. I think there's more of an ups. That's why I believe more in crypto and digital assets. There's more of an upside for the market as a whole, as opposed to the entire equities market. There's some gems out there, but that's how I see it.
All right, James, over to you. Any last thoughts on that question?
Yeah, I don't think, having a lot of, liquidity QE, of course, helps all asset classes, rise all boats. But remember, there's a lot of it still slushing around in the system and has yet to be deployed, hence the 3 trillion on the sidelines. The other big thing that's actually happened too, which people don't really look at, is everybody invested in a 60-40 portfolio for the longest time, 40% bonds, 60% equities. That's done. People aren't going to do that anymore. So that 40% needs to find a home. So people have been preaching this as well. People like Raoul Paul and Stanley Druckenmiller and others, just put 2 to 5% into Bitcoin, and then the rest in something else, some like the disruptive equity or whatever else. That's what people are going to start learning and doing, and that's where the liquidity will come from in the next round, as long as regulators don't kill the asset class.
Let's hope they don't.
Yeah.
I think that's going to be the biggest fear for. I don't think they will. I'm optimistic that they won't, but I think that'll at least be the fear that leads to no major bull market no earlier than say a year from now, right? Like a year from now, we're gonna have the halving in sight. Hopefully, inflation's coming down. Perhaps the Fed is implementing some form of QE, and we can start to go higher. But as we talk about all this, actually, the Dow's going lower. The S&P is now putting in a new low, and the Nasdaq is getting very testy, and it's about to put in a fresh low itself. I don't know if it's going to put in one or not, but I was actually looking because I know the Nasdaq's just below its 200-week SMA, so it's interesting to go back and look at that. The prior times it went below that, see what happened after that. But we got to wrap it up. We've been going for an hour. Thanks everyone for tuning in. If you're not subscribed here, go ahead and subscribe. More importantly, subscribe to James, subscribe to Rob. You can find their channels in the description below. Next week, whose channel are we going to be on? We'll be on Rob's channel next week. So make sure you tune in there next week. We'll have a lot of great discussions, and we will wrap it up. Thank you guys for tuning in. See you next time.
Thanks, everybody.